Welcome to our today's lecture on quantitative risk management. Last week we stopped at our different examples for risk mappings, and we want to continue with this today. We start with a very simple first example of a stock portfolio. So we have D stocks. Okay, we have D stocks. We use different weights. This is lambda I. Each lambda describes the number of stocks I in the portfolio. We have prices of these different stocks. They are modeled using a process STI, so stock price at time t, and I being the ith stock. And we then first calculate the relevant risk factor. In this case, we assume that the risk factor is the log return of the stock. So ZTI is defined as the natural logarithm of STI, and the changes in the risk factors are then the log return. So these are the logarithmic prices, and the risk factor, actually the only factor for one stock, is then given by the log return on the ith stock. We are looking at a portfolio, and the value of the portfolio is given by, remember that we don't have the prices here, we have logarithmic prices, so we have to take the exponential function and plug the logarithmic prices into the exponential function, weight it with lambda I, and then, for example, we have 5 stocks of stock I, 6 stocks of stock J, for example, and so on. And Vt is the value of our portfolio at time t. This is just to clarify that the exponential function at ZTI is the price of the respective stock. Now, remember, risk factor, risk mapping, we're interested in the end in the financial losses. The financial loss over time is given by the negative difference of Vt plus 1 minus Vt. And this then, you only have to write Vt in here and here, is given by minus the sum over all the investments, the number of stocks, lambda I, times STI, times the exponential function at the log return minus 1. So that's very simple, the stock portfolio loss. We do a linear approximation. The linear approximation of LT plus 1, L delta T plus 1 is given by minus the sum over all weighted prices times the log return. And if you write this in a slightly different way, you can take the VT, the initial portfolio value in front, and what you're getting is minus the portfolio value times the sum of the weighted log returns. This isn't really surprising because in the end, under this assumption of a linear approximation, this simply means that, for example, the financial loss is given by, I've invested, say, 100,000 euros into the portfolio, and I calculate the mean, the average return of the portfolio, say minus 5%, and then it's minus 100,000 times minus 5%, and then again the losses are positive numbers, profits are negative numbers. It's very simple, the portfolio loss. Why is this, or how can you calculate this linear approximation? You have to remember the formula from last lecture where we saw that by taking the partial derivatives of the risk mapping itself with respect to time and with respect to the individual risk factors, gives you this linear approximation. And in this case, it's very simple. The partial derivative of the risk mapping with respect to t disappears, and all those derivatives with respect to the different risk factors, so FZI, they add up to Vt. Yeah? Simply take this formula, and if you know how to handle partial derivatives, if you know how to calculate them, you will see that this is actually very simple. And the weights are simply lambda I times STI divided by the portfolio value. So this is nothing but the initial portfolio weights. So these characterize the part of the portfolio value that was invested at time t in this stock I, and the corresponding linearized loss operator is also the same. It's simply minus the value of the portfolio times the weighted portfolio return. Not very surprising here. Why did we do this linear approximation? Very simply, we want to impose the assumption of a normal distribution on those risk factors. The nice thing about the normal distribution is that it is invariant under linear transformations. Meaning what? If you have individual distributions, if you have individual risk factors, and the risk mapping is linear, then the portfolio losses will also be normally distributed. So risk factors, normal distribution, linear risk mapping, and what you get is a normally distributed portfolio loss. Very nice. And this is why, first of all, we impose a linear approximation. Then this risk mapping here that we get is linear. And if we now assume a normal distribution for those risk factors, xt plus 1i, then the losses are also normally distributed. So this is what happens then. The expected value of the losses is simply given by, well, this is in the multivariate case, you need to take the squared portfolio value, you need to take the weight vector, and sigma is the variance-covariance matrix of the normal distributed risk factors, of all those individual stocks. And for each stock, we have one log return, and each log return is one of the risk factors. Okay, so this is a very simple example where you can see the linear approximation risk mapping in action. In this case, you could argue, well, this is okay. If you had used discrete returns, you wouldn't even have to use the linearization. The risk mapping would immediately have been linear on its own. Even if you use log returns, by assuming a linearization of the risk mapping, you can impose a normal distribution of the risk factors, and what you get is normally distributed loss function. The losses are normally distributed, and that's a nice feature. Let's look at the next example, the example of a European call option. Now, I hope you're all familiar with what a call option is. You should know from other lectures that the Black-Scholes option pricing model is by far the most central and most widely used model for coming up with a price, with a theoretical price for a call option, or for any option in that sense. And we now define the function C, Bs, C, the price of a call, Bs for the Black-Scholes model, and it depends on small s, capital S, R, sigma, K, and T. K is the strike, T is the maturity, sigma the volatility of the underlying stock, R is the risk-free rate, S is the stock price, and S is the current point in time where we S. So this is the current point in time, S is the stock price, R is the risk-free rate, volatility, strike, and maturity. The Black-Scholes model tells you, you will learn about this later, maybe in other lectures, or you've already seen this in financial risk management or computational finance, that the Black-Scholes model gives you a price, an arbitrage-free price of such a call option, of a European call option, and it's given by the stock price, current stock price, times phi, the distribution function of the standard normal distribution at point D1, minus the discounted, discounted strike times phi at D2, and D1 and D2 are given by these formulas. You don't know, and you don't need to know about these formulas in detail, even if you're not familiar with the Black-Scholes model. Simply accept the fact that this is an arbitrage-free price, theoretical price for such a call option. Now, we are interested in daily losses where the time t is measured in years. Consequently, we put, as a rather simplifying assumption, we put delta equal to 1/250. We assume we have 250 trading days. In the Black-Scholes framework, interest rate R, volatility sigma are assumed to be constant in the basic case of the Black-Scholes model. Obviously, again, a simplification. And what risk factors do we have? Now, we've seen from the pricing formula C here that the value of a portfolio that consists of these options is given by, the value is the pricing formula, T times delta, ST, RT, sigma T, strike, and maturity. Now the changes in the risk factors are then given by the change in the stock price, the change in the risk-free rate, and the change in volatility if it's not constant. So these three risk factors, these three are the deterministic one. It's obvious that from today until tomorrow, the change is deterministic. It's one day. The strike is fixed, maturity is fixed. So the only thing that can actually change is the stock price, the underlying price, the risk-free rate, and the volatility. Now, if you linearize it, we get minus the partial derivative of the stock price with respect to small s, so the point in time times delta, plus the partial derivative of the pricing formula with respect to the stock price times st times xt plus 1, plus the partial derivative with respect to risk-free rate and with respect to volatility. The arguments of these functions are suppressed because otherwise the formula would have gotten out of hand. But as you can see, if we linearize this pricing formula, you can see that the risk mapping and the financial losses from such an option investment depend on the partial derivative of the Black-Scholes option price formula according to their arguments. Time, risk-free rate, underlying price, volatility. This is no surprise. And actually, these partial derivatives, they have a special name. They have a special name and they are called Greeks because they are abbreviated with the Greek letters with one exception. So you have the option delta, the sensitivity to stock price, the option theta, the sensitivity to time, the option rho, the sensitivity to the risk-free rate, and this is not a Greek letter, nevertheless, it's called the option vega, the sensitivity to volatility. So V vega volatility, rho R interest rate, T time theta, and D stock price, the option delta, that's the sensitivity to the stock underlying price. We do have some other sensitivities or elasticities, the second partial derivative, second order derivatives, but we don't need these at this moment. It's sufficient to see that here, for the financial losses of the linearized loss operator and the linearized loss risk mapping, suddenly you encounter the partial derivatives of the option price, and this is so important that actually these have special names. By the way, the option delta is by far the most important risk measure for options, and you can see this here. It enters our financial losses with a huge weight, and that's the option delta. Do you see another reason why the option delta is so important? If you've already taken the class on financial risk management, you know that option delta is also used in delta hedging, but there's another simple reason why the option delta is so important. You can assume that in the simplest case, you could simply assume volatility is constant, so it's no longer a risk factor, and risk-free rate is also constant, it's no longer a risk factor. So what you're left with is actually only one risk factor, which is the option delta. So this is one reason why the option delta is so important in industry practice. Now, how can the quality of the approximation of the true financial losses by the linearized losses be estimated in the case of an option portfolio? That's a question. Any idea? How can you evaluate, or how would you see the quality of this approximation? Now, this example is quite illustrating because, as you can see here, we have the standard normal distribution function in here, and you have the logarithm of ln sk, you have a square root of time in here, you have volatility in here. Problem is, the Black-Scholes pricing formula, the pricing function, is highly non-linear. And if we were to use a linearization, as we've done here, on a highly non-linear function, obviously the approximation will be pretty bad. And this is what happens here. So yes, you can do this, and it is possible theoretically, of course, but the problem is that because in the case of an option portfolio, these are non-linear instruments, the approximation will not be very good. At least not as good as in the case of the stock portfolio or as in the next example. And this is the third and last example here, the bond portfolio. So we are looking at a portfolio that consists of D risk-free zero coupon bonds with maturity TI and a price P depending on the maturity and current point in time S. The time is again given in years. Lambda I is again the number of instruments we have in our portfolio. And we now write Y S to T as -1 over T minus S of the logarithmic price. So that's the return of a zero coupon bond with constant interest, and the price of the bond at maturity is normalized to 1. So what we can see is the price is simply the yield inserted together with the remaining maturity on the bond in the exponential function, and this is simply a continuous compounding discount factor. Very, very famous and very frequently done in financial mathematics. You normalize the price of the bond, the notional, to 1, meaning that you have a cash flow of 0, 0, 0, and then at the very end you have 1. This also means that what is the price you have to pay for this? Well, if in the end you're only paid out 1, what is the price? It's actually the discount factor using the spot rate over, well, let me count, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 years. This discount factor is equal to the price of this risk-free bond, this risk-free zero coupon bond. Famously done in financial mathematics. Financial mathematicians are not working with discount factors. They are working with zero bond prices because it's equivalent. And you can see this here. If you normalize the price of the bond, the notional of the bond, to 1 at the very end, what you're given is the yield is simply here, the price is simply the discount factor, and the yield is the spot rate. Okay. Now this mapping of the maturity to the different yield is called the yield curve, or the interest rate structure, or the term structure of interest rates. It's frequently and always done. It's frequently calculated and estimated by central banks. You can look it up. In this case of our example here, we are assuming a constant interest rate, so it's a flat yield curve. If you go to R, the package yield curve, you can actually have a look at the European Union's yield curve. So this is the ECB yield curve 1. I think this is slightly different. The very first, and you can see we have what we call a normal interest rate structure, or term structure of interest rates, or yield curve. It's normal because it goes up. This one is a flat one, and this one would be considered an inverse term structure of interest rates. This is an example from the Stuttgart Stock Exchange. They did the same. Pretty old, I guess. As you can see, back then the yields even went up to 4%. I think this is a plot that is close to 10 years old, when zero interest policy only started. Nowadays it basically all looks like this. Looks like this. Okay. Now we need the returns, the yields, y, as risk factors for the bond portfolio. The value of the portfolio is given by v at point S equal to the weighted sum of those different prices. Lambda I, again, were the number of bonds in our portfolio. We now express this in terms of return. So we substitute the prices for the return. So that gives us the sum lambda I times the exponential function of the discount factor minus ti minus t times delta times the yield. The portfolio loss can be calculated quickly from this. We directly look at the linearized losses. So this gives us minus the sum of the weighted prices times the yield times the change in time delta minus the remaining maturity times xt plus 1 as the risk factor. So the change in yield, this is the risk factors, or these are the risk factors. The change in the yield for each and every bond we have in our portfolio. Okay. In the next step, let's consider the special case of a flat interest curve. That is, we don't have different yields for different bonds, but actually the bonds, now the yields, are the same for any maturity. So it doesn't depend if we invest for 5 years or 10 years, the yield curve is flat. Then we get that actually we allow a parallel shift up or down. So instead of looking at these yields from S to T, we only need to look at the yield at point S. And if we add an amount of time delta to it, then this change in the yield suddenly becomes the current yield plus a constant up or down of delta. So we are shifting the yield curve, which is flat. I have a line, no, sorry, to try to draw it like this. And for example, the yield curve simply goes down by delta. So this is the change. Then in linearization, in linear approximation, we get the following for the linearized losses. It's minus Vt times yield times amount of time delta minus the sum of the weighted prices divided by the value of the portfolio, the initial value, times the remaining maturity of each of these bonds times the increase or decrease in the yield curve. In other words, it's minus the portfolio value times the yield times delta minus d plus delta times delta. And what is capital D? Capital D is, now we substitute this with D. D is the weighted sum of the prices times the remaining maturity on each bond. You've probably seen this in another lecture. This quantity, this formula is the so-called duration of the bond portfolio. It's the weighted sum of the bond prices divided by the portfolio value times the remaining maturity. And the duration describes the sensitivity of the portfolio value to a parallel shift in the yield curve. And in practice, what you're trying to do is you try an immunization of the entire portfolio with the help of a duration of 0. You are looking at a duration of 0, and then you you hedge against any change in the yield curve. Now we have one last example, a portfolio of loans that a bank, for example, has granted to its customers. Basically, the investment in loans is exposed to several risk factors: default risk, interest rate risk, etc. And we consider a portfolio of loans with M counterparties. Notional value is always EI, E for exposure, delta is 1 year. We assume that all loans will be repaid at the time capital T, and that there are no previous partial repayments. Very simplifying assumption here. Then we have a variable y, ti, that is a random variable. That's what RV stands for, a random variable that obtains the value 1 if the borrower defaults and 0 otherwise. So it's 0 if the bond is still bound to be paid back, and it's 1 if you have a default. So YTI is nothing but a default indicator. We assume that the recovery rate of the credit of the loans is 0, meaning what? It simply means that in practice, you have a recovery rate of maybe 10, 20%, even 50%, so that even if a customer defaults, you're able to recover at least 20%, 50% from the proceeds from the bankruptcy procedure. We assume that if a loan defaults, in this case, in our model, everything's gone. Okay. Now, this should also be a loan, not credit here. So we have a loan. We first evaluate the cash flow of a loan. At this, as this is exposed, okay, to the default risk, I have to make some corrections here. We have to discount the cash flow EI with a risk-adjusted interest rate. More precisely, we use the risk-free interest rate plus a risk premium for taking into account that we bear default risk. So the value of the loan is basically the same as in the case of a bond. However, we need to use the yield, the risk-free yield, plus an individual loan-specific credit spread. It's a credit spread because it is a risk premium on top of the risk-free rate or risk-free yield for bearing default risk. So with Y, the risk-free yield, and CI, the firm-specific or borrower-specific credit spreads. The credit spreads are often determined using corporate bonds, and you can also use formal models. We'll get into this later on. But in our model, simply assume that it's a retail customer portfolio. They are all the same. So let's simply assume that all those credit spreads are constant. So in summary, for the value of the loan portfolio, we get what? The value is the sum of 1 minus the default indicator times exponential function of this discount. This is actually the yield, taking it together with the exponential function, and the remaining maturity means that this here is a discount factor. This is the exposure. That's the notional of the amount of money we've given out in a loan. And why do we need to include 1 minus the default indicator? Because the value is obviously 0, so it's 1 minus 1 if the loan has defaulted. So any loan that has defaulted will enter the value VT with 0. In the other case, we'll simply have 1 minus 0, so 1 times the discounted, the present value of this loan. The risk factors can then be summarized into an M plus 2-dimensional random vector. We have the risk-free yield, the constant default rate or default premium, and all those different default indicators. And you can then look at the loss, the risk mapping. This is actually the risk mapping. You can look at the linearized loss mapping, and then these M plus 2 factors, those are your risk factors. The credit spread, the yield, and obviously the default indicators. And because these might be interdependent, you have to look at the correlation between those default indicators. Might be that if loan 1 defaults, that loan 2 will also default. So you have interdependencies between these default probabilities, and you need to take these into account. So you can then start from there, look for a distribution of these default rates, look for a statistical model for coming up with the different risk factors, and we'll see these later on in action in the later part of our lectures. Okay, so then now let's move to risk measures, which is the next big section here in our QRM lecture. We'll start with the basics of risk measurement, talk a little bit about axiomatic risk measure theory, and talk about some important risk measures later on. Now, we've talked about risk factors in the last two lectures actually. We've seen that these influence the possible losses on an investment. What we haven't talked about is what we should do next. Coming up with a risk mapping, coming up with a distributional model for our financial losses, in the end gives us LT+1, the distribution of the losses. But we haven't spoken about what we are doing with the distribution of financial losses next. We need to come up with some proxies, some measures, some moments that we can calculate based on the distribution of those financial losses to work with in risk management. So we need to operationalize risk. We'll discuss some standard procedures, some standard proxies for risk, but we'll first start with the idea that we need to come up with some proxies based on those statistical distributions for the financial losses. We've already seen some of these examples. For example, the Greeks of the Black-Scholes option pricing formula. They were sensitivities of the option price to variations in the model parameters in the risk factors. So they could be used to measure the sensitivity of your losses to change in the risk factors. Problem is, risk measurement on the basis of factor sensitivities has some serious disadvantages. For example, the sensitivities, they cannot be aggregated. You cannot combine a sensitivity of, say, the option price with respect to time and the sensitivity with respect to the underlying price. It doesn't make any economic sense to combine these two. But since risk measurement is largely about combining risk measures, it's about allocating risk capital, it's about diversification effects and measuring diversification and maybe even cluster risk effects, sensitivities don't really play into that. Another possibility of measuring risk is given by so-called scenario-based risk measures. Let's look at one example. We consider a set x1 until xn of risk factor changes. Those are scenarios. For each scenario, we have a weight, and we are now given any risky portfolio with the associated loss operator, and we can then build a portfolio risk by measuring it with taking, for example, the maximum of plugging into the scenario x1 into the loss operator. So this will give us one loss, I call it L1. We weight it. So for example, we say this is a scenario x1 that has a probability of 1%. We have a scenario xn, which has a probability of, say, 99%. Then we plug it into the loss operator. We can see what potential losses would arise from this scenario. We weight it with 99%, and then we take the maximum out of this. Very simple approach. It's not really founded in economic theory, but it's very practical. Such a scenario-based risk measure model is actually used, for example, by the CME or the Hong Kong Exchanges and Clearing to determine margins, to calculate the amount of money that traders have to keep in their margin accounts. For example, they say where a client maintains a margin account with the exchange participant, he will be required to pay margin on both long and short positions based on the, there's one S too much here. It's called the Standard Portfolio Analysis of Risk, or simply SPAN margin methodology. SPAN is a risk-based portfolio approach for calculating the daily margin requirement, which has been developed by the CME, and so on and so on and so on. SPAN evaluates the risk exposure of a portfolio by varying these two factors. For example, futures price movements, price risk, and changes in volatility. And SPAN constructs scenarios of futures price movements and volatility changes to see what the entire portfolio might reasonably lose in the following trading days. So this is exactly the same model that is used by the CME and the Hong Kong Exchange and Trading and Clearing, sorry. And you can do this. However, again, we have a problem here. It's completely void of any theory, and it might also turn out to be difficult to choose and to select these scenarios. Also, we cannot really compare these scenarios because we have too much leeway and too much flexibility in choosing the weights for these scenarios. As you can see here, I simply made up 1 and 99%. How should we measure the probabilities of these different scenarios? It's difficult in practice. So in the following, we will do what we intended from the very start. We'll concentrate on the standard in risk management, in quantitative risk management, looking at statistical loss distributions. We are modeling loss distributions, and we are then calculating moments or any risk measures based on statistical distributions. So in general, it can be stated that nowadays almost all quantitative risk models carry out a risk measurement on the basis of statistical indicators or moments or measures, values which are based on conditional or unconditional loss distributions. You can criticize this. For example, you could argue you have model risk. You have to choose the distribution. You have to estimate it. You need data. But all this also comes with huge advantages. For example, in financial risk management, we are mostly concerned about financial losses. So it does make sense to look at losses in the first place. The loss distributions can, at least theoretically, be summarized on on any aggregation level. Individual investment, portfolio, even a company, or even a whole financial sector. Financial losses measured via statistical distributions take into effect netting and diversification effects, and you can compare those loss distributions with each other. So many advantages. It has two disadvantages, as I mentioned. You need historical data, and you have huge model risk, meaning that you can choose the wrong model, the wrong mapping, you can forget about some risk factors, you have incorrect assumptions on the risk factors, etc. However, both arguments only make a stronger argument for the use of loss distributions and for the need of careful modeling and looking out for a proper statistical model for those risk factors. So yes, model risk, but you need to take this into account, and you need to think about model risk just like you would think about, for example, historical data. Okay. Next, it is obviously not yet sufficient to work with the loss distributions itself. What managers, and especially top management, is looking for is key figures, moments, single values. They are not interested in the risk manager in drawing such a line saying, well, this looks okay. They want a figure. They want something like this. Risk is $100 million. They need, especially top managers, CEOs and chief risk officers, they want to see a condensed version of your risk measurement and of risk measures, and ideally they want to see one number, one traffic light, and they want to make sure that this traffic light is green. So what we need to do is we need to use these distributions, and we need to calculate one number. For example, the expected value, den Erwartungswert. We could also say we want to calculate the median value, which might be here. Or we take volatility. It looks like this. And later on, axiomatic risk measure theory looks at the theoretical problems associated with some of these key figures or moments or single values based on loss distributions. So let's talk about risk measure theory. Now, this theory is based on one fundamental paper by Arzner, Delbin, Eber und Heath in Mathematical Finance in 1999 or 2000, I think. And the basic idea of the paper was to lay down a set of axioms, rules and laws that you cannot prove. You simply assume them to be right. To lay down a set of axioms that each risk measure should fulfill. And we'll soon see what these axioms are. And they can be used to assess known risk measures and to see if these risk measures, like for example volatility, if they are good or bad risk measures in the sense of this axiomatic theory. Now, the original paper is it's a mathematical paper, so we'll suppress many of the details, especially the derivation and the proofs of these results. They are based on so-called acceptance quantities and acceptance sets, but it's not that difficult to understand the basic gist of it. So if you're more interested in this, especially if you're studying mathematics or financial mathematics, you should take a look at this paper. It's very interesting. So we start again with a stochastic space and a time scale. We designate by L0 the set of all random variables that are almost everywhere finite. So we're excluding random variables which can go to plus minus infinity. That's all we're doing here. The financial risks then represent a subset of L0, meaning that a financial risk is a random variable. It's all that simple. A random variable is a risk. A risk is a random variable. We assume that M is a convex cone, ein konvexer Kegel. That is, if we have two risks, two random variables, then the sum of both risks and a positive scaling, for example, if we have two risks, x and y, this means that if they form a convex cone, that's x plus y is an element. I have to write it in this way. Let's say this is an element of M, and a times x is also an element of M, with a being larger than 0. So any positive scaling of a risk x and the sum of two risks x plus y both fall into M again, and that's what is meant by M is a convex cone. Ein konvexer Kegel ist eine Menge, sodass, wenn Sie zwei Elemente aus M addieren oder einfach ein Skalarprodukt bilden, mit einem positiven Skalar a multiplizieren, dann ist beides wieder in dieser Menge M. Okay, so that's a convex cone. What is a risk measure? A risk measure is a real valued function, v, from M to the real numbers. So we are assigning a real number to each risk M. And the value nu of L, with L being a risk, we already write L because it's meant to be a financial loss, is meant, or it's intended to be the capital sum that must be added to the risk to make it acceptable for an internal or external decision maker. Could be the CEO, could also be a regulator, could be the government. So if nu of L is negative, then the risk is acceptable and the amount minus nu of L can be taken from the position without making the risk unacceptable. It's very simple. If nu of L is negative, say it's minus 5,000 euros, it is, for example, a bank account. A bank account is not risky, and we can withdraw 5,000 euros from that bank account, then it's 0. It still poses no risk. That's the case of a risk measure having a negative number. If, however, if we have a positive number of, say, 5,000 euros, this means that we need to add 5,000 euros to make this position, this investment, acceptable. That's the first thing. So we can see some risks, understood as RVs, they can be hedged, and we can insert an amount of money to make it acceptable. And we even have some financial positions from which we can withdraw money and take money out of it, and it's still acceptable to the regulator or the CEO. Then the first axiom. The first axiom is the one of translational invariance. Translationsinvariance. It means that the risk measure nu is translationally invariant if for all risks L and every small l, the following holds. If we add any amount of cash, this is cash, if it's added to a risk L, it means that it is simply the risk factor of nu of L plus the amount of cash. It means that if we add a safe amount of money, a safe amount of cash L, it reduces the required risk capital from this position exactly by L. In our example, it means that we have this position here, this is a risk position, and we are looking at a portfolio of, say, L plus the 5,000, It simply means that we can only accept, or we can only expect, the necessary risk capital to make this risk acceptable or unacceptable to change by exactly the amount of L. That's translational invariance. In geometry, translational invariance means that if you have an object in space and you move it in space, it doesn't change. And in Euclidean geometry, at least, this is very simple. By moving objects in space, they don't change. However, in, say, for example, computer graphics, this is different. Even if you're watching my video now, look what happens now. My finger, as I move it towards the camera, becomes bigger on your screen. And this is true because, well, we are using something here. We are using mathematical technique to reduce the 3 dimensions where I'm sitting to the 2 dimensions of your computer screen. And this effect, what you can see right now, this is an effect where you have a space that is not translational invariance because my finger stays the same, but you can see it larger or smaller as I move it apart and away from the camera. So this here means the risk measure is translationally invariant if the objects stay the same size regardless of where I'm looking at it and if I'm moving it in space. The second axiom is subadditivity. The risk measure nu is subadditive if to all L1, L2, for any 2 risks, we have that nu of L1 plus L2, that is the portfolio. The risk capital needed for the portfolio is smaller or equal to the risk capital for L1 plus the risk capital of L2. Meaning what? With a subadditive risk measure, the portfolio risk is bounded to the sum of the individual risks. The required risk capital for the portfolio is bounded to the above by the sum of the individual risk capital sums. If this is not the case, the risk measure will punish diversification efforts. That's why we expect a risk measure to be subadditive, so it can model diversification. The third axiom is the one of positive homogeneity. The risk measure nu is positive homogeneous if to all risks L and all positive scalars lambda, we have that if we scale the loss L, we also have to scale the risk capital exactly by this amount lambda. Meaning what? It states that if we invest 5 times the cash in a risk, we also need 5 times the risk capital. It doesn't grow or it doesn't shrink. If we buy 5 stocks, we have 5 times the risk and we need 5 times the risk capital. This is not obvious because it might be that if you invest more and more money, your total risk actually increases because you have liquidity concerns. We'll get back to that later. And last but not least, we have monotony. The risk measure nu is monotonic or monotonous if for all L1, L2, with L1 being smaller or equal than L2, we have that nu of L1 is smaller or equal than nu of L2, almost surely. Forget it at this point. What it means is if, for example, we have risk measures in state 1 and state 2, we have, let's say, a loss of 5 and we have a loss of 6 and we have a different risk that gives us 8 and here 6, we have a loss of 9. You can see that here in all those scenarios this risk is worse, and monotony means that then the risk capital also means to be higher for this risk than for the first one. There is, however, one confusion often with students and people who are looking at this. If we have the situation that we have a risk that looks like this, 4 and 12, monotony doesn't say anything about this scenario, because here we can see that it's worse here and it's better here, so we cannot make any statement on this comparison between L1 and L2. L1, L2 need to be, or L1 needs to be smaller or equal to L2 in all settings and all scenarios. That's the important part. I'll say this in German again. Die Zufallsvariable L1 muss in allen Zuständen immer kleiner oder gleich L2 sein. Diese erste Variante, dass wir zwei Zufallsvariablen haben und die eine ist mal besser, die andere ist mal schlechter, je nachdem, in welchem Zustand wir uns befinden, darüber sagt die Monotonie nichts aus. Wir sagen nur etwas darüber aus, wenn L1 echt besser ist in allen Zuständen als L2. Dann muss natürlich auch das Risikokapital hier echt kleiner oder gleich sein als für das zweite Risiko. That's monotony. Okay. Now, if we have axioms 1 through 4 fulfilled by a risk measure nu, this risk measure is famously called a coherent risk measure on M. That's why the paper by Arznadel, Eber und Heath is also called Coherent Measures of Risk. A coherent risk measure is a risk measure that possesses nice properties. Properties that make economic sense. You can scale it, it's monotonous, it is subadditive, and it's very nice. And we are looking for these features in an economically sensible risk measure. So that's axioms 1 through 4. Now, we can also look at so-called convex risk measures. We don't need to go into detail in this. I already told you that the positive homogeneity is a very strong assumption and a strong requirement on a risk measure. It means that you can buy 10 stocks, you can buy a million stocks, it doesn't matter. You have positive scaling of your risk capital. This is unrealistic to some extent because it might be that actually you run into risk concentration in cluster risks, or you have liquidity concerns. If you, for example, buy one stock, no one cares. If you buy up all the stocks of, say, Tesla, at some point the prices will react because you're cornering the market. So liquidity problems might lead to a situation where actually the risk of your scaled up portfolio is actually larger than simply n or lambda times the individual risk. And to make this possible, you can loosen the axioms of positive homogeneity and subadditivity, and what you get is convexity. Risk measure nu is called convex if for all risk L1, L2 and all lambdas, the following applies: the risk of a convex combination is smaller or equal than this here, the convex combination of the individual risk capitals. That's convexity. You've now seen it. If you ever encounter it, remember it, otherwise it's probably not so important for practice. Now, at first glance, the basic principles of risk measure theory that are presented here, they appear very, very theoretical. However, this is a very nice part of this lecture where you can see this is pure probability theory. This is pure mathematics, or applied mathematics rather, but it has serious consequences for practice in risk measurement, because mathematicians went on after 1999 and they had a look at those different risk measures that were used in practice, in industry practice. And what they found is they found serious theoretical disadvantages for some of our risk measures. For example, missing subadditivity, that these risk measures actually punish diversifications in some cases. And this has led to the development of new, or at least the support for different risk measures, most notably the so-called expected shortfall. So let's look at some important risk measures that we find in practice. Most notably, we start with mean loss, variance volatility, maximum loss. Let's take a look at these three here. So mean loss, variance volatility, maximum loss. We can actually shorten this discussion here. Problem is, with the mean loss, it makes sense for some cases. For example, in credit risk, the expected loss from a loan is actually used in risk management. How is it used? If you take the expected loss, this is simply used for pricing. If you already expect this kind of loss, you include it in your price, that is the interest rate you are asking on your loan. For variance volatility, it's difficult. Problem is, variance can go up if prices go up. Volatility goes up if prices go down. It simply measures variability. and even profits are punished when using volatility or variance. The maximum loss, the infimum of the distribution, is also difficult because this is a very unrealistic maximum loss. And you can take the famous saying, in the long run, we are all dead. You're not managing on the basis that you assume, well, my company can go bankrupt. That's not the case in risk management. So all of these losses and risk measures have serious disadvantages. Variance is non-negative, not even a risk measure in the sense as it was defined above. Maximum loss and expected value are not robust against extreme values. In addition, they are very pessimistic. Expected loss, as I mentioned, is used in credit risk modeling, but for pricing, not for looking at capital. What we can do next is we can look at the most common risk measure in practice there is, the so-called value at risk, or simply VaR. Credit institution banks are permitted or were permitted to first use VaR models for internal bank management and for calculating regulatory capital for the market price risk based on supervisory law, principle 1, Grundsatz 1 in German banking law. And we have similar regulations in solvency regulation in Basel I, Basel II, and Basel III. And due to the fact that it was recognized by regulators as a risk measure for calculating risk capital, VaR has developed to the industry standard for measuring market price and credit risk. However, this is the first instance where we see that risk measure theory has a practical implication, because VaR is not coherent. It's not subadditive, not at least for all distributions. So how is it defined? It's basically a quantile. If this is your P&L distribution, it's a quantile, for example here, so that you have 1% of probability mask here and 99% here, then this point here is your 1% value at risk. So by taking the distribution of your P&L or your losses, the value at risk is now the maximum loss that is only exceeded with a given probability. So it's exceeded in 1% of all cases and not in 99%. The fine formal definition is given on this page. Let alpha be an arbitrary confidence level. The VaR of the portfolio is given at confidence level alpha by the smallest number L, such that the probability that the loss L does exceed small l is not greater than 1 minus alpha. So it's the infimum of a real number L such that L inserted in the distribution is larger or equal than alpha. This is the definition of the alpha percent VaR. It's simply a quantile. In practice, we often see alpha being 95, 99, or even 99.9%. The time horizon in market price risk management is often equal to 10 or 1 trading days. In credit risk management, it's often 1 year. That's the usual time focus in credit risk management. By definition, the value at risk does not allow any statement to be made about the amount of losses that occur beyond the VaR. So it could go on like this. It could also go on like this. We don't know anything about the losses beyond the VaR. We only know that the VaR distinguishes alpha and 1 minus alpha percent of the probability mass. So this is very important because many practitioners don't see this, don't understand this, and they only expect that VaR gives a lower bound for the losses. No, it gives a lower bound, it gives a bound for the 1% in contrast to 1 minus alpha percent, for example. You can also calculate a variation, the so-called mean VaR, which is simply the VaR minus the expected loss. But both, from a statistical point of view, they're nothing but a quantile of the loss distribution. So let's look into this in more detail. We've already seen the generalized inverse. We need to look at the generalized inverse because for some distributions, you cannot invert the distribution function. So this is the generalized inverse, and we get the inverse function or the quantile function f minus 1. And this is, if we use the generalized inverse, this is the quantile function of our distribution, and we show this by this arrow here. So this is the quantile function Q alpha of f of the distribution. And assuming that the losses are normally distributed with expected value mu and variance sigma squared for a given confidence level, we can immediately calculate the VAR analytically for a normally distributed loss distribution. The VAR alpha is simply given by mu plus sigma times the inverse the quantile function. The same thing here for a t-distributed, standard t-distribution with new degrees of freedom. Also we need the expected value, we need sigma, and now we need the quantile of the t-distribution. Very simple. Let's take it to practice. This is the P&L of the trading department of Deutsche Bank in 2006, before the financial crisis. And what is done here is they're showing the profits and losses on a daily basis. And you can see the value at risk estimates for each day. And as you can see, they came close to having a loss as forecasted by the value at risk. But fortunately for Deutsche Bank in 2006 at least, they never crossed the value at risk. They had no so-called VAR exceedance. If you were to look at 2007, 2008, during the financial crisis, it looked like this. It looked like this. They had many, many more VAR exceedances. Could still be okay, because the VAR only says something about the number of VAR exceedances, not about the financial losses. As I told you, a severe disadvantage shown by Arzner et al. The value at risk is not subadditive. It is only subadditive for so-called elliptical distributions, and the most important ones are the T and the Gaussian distributions. Otherwise, it might not be subadditive and thus not coherent. Now, what can you do when you know that the value at risk is not coherent? Well, first of all, the lack of subadditivity, but also the fact that the VAR doesn't say anything about the losses beyond the VAR, so about tail risk, has led to regulators and banks to more and more adopt the so-called expected shortfall. What is expected shortfall? Expected shortfall is defined for any loss in any distribution as the ES alpha given by 1 over 1 minus alpha and the integral from alpha to 1 over the quantile function. What does this mean? Well, if we look at it this way, as a first observation, you can see this is actually sort of a weighted average value at risk. But even more important, if we have a continuous distribution and if it's integrable, then the expected shortfall becomes what? The conditional mean of L, given that L is larger or equal than the VAR. If this is your profit and loss distribution, and this is your value at risk, then the expected value is simply your average, your conditional mean of the losses that are in the tail left of the value at risk. So it's the conditional expected loss under the condition that you're only looking at the worst losses that are even worse than the value at risk. That's the expected shortfall, as that's the most common economic intuition and interpretation. It's the average loss that is worse than the value at risk. And you have two main advantages. First one is you're measuring tail risk. You're looking at the tail beyond value at risk. And the second advantage is theoretically expected shortfall is coherent, as shown by Acerbi, I think Acerbi and Tasche, but also later on by Acerbi and Bach. So expected shortfall is coherent regardless of what distribution you're looking at. Problem with expected shortfall is it's very difficult to backtest. And now we're coming to backtesting. So let's assume we have historical VAR estimates and we also have expected shortfall estimates. We now want to test whether our risk model is really capturing actual losses. And backtesting is exactly this process of checking whether your risk model is adequate. It means the process of assessing the quality of a risk model based on historical data. In the case of VAR backtesting, you're comparing estimated value of risk with actual losses. We have several standard tests for VAR backtesting. The most famous ones are the Kupitz test, the test by Christoffersen, Pelletier. The basic idea is that you have an indicator variable. Let's assume these are your losses. And what you're then doing is you're estimating your valued risk. And you see that you have, I need to use a smaller, you have 1, 2, if this is discrete, 1, 2, 3, 4 exceedances. So you would write it like this. I'm sorry. And, okay, probably like this. Well, you get the idea, no? So you have an indicator variable of VAR exceedances. In these tests, you can show that they should be under the assumption that the VAR model is adequate. It should be binomially distributed with probability 1 minus alpha. And you also need to check for the randomness of VAR exceedances. So it should rather be something like this. This is random in contrast to 1, 2, 3, 4, 5, 6, 7, 8. As you can see, the same number of ones, the same number of zeros, but in the second case, it's systematic change and clustering. In the first case, it seems to be random. So you're looking for the right number of VAR exceedances and a randomness over time. That's what these tests do, and we'll see this later on. Okay, so let's quickly look at some standard techniques for calculating VAR. The standard technique, first of all, is the variance-covariance method, meaning that's also called the delta normal approach. We assume that the risk factors, conditional or unconditional, are multivariate normally distributed. So the risk factors are normally distributed. We've already seen what happens. Then the portfolio also follows a normal distribution. And then we get, under the assumption of a linearized loss operator, we have this particular structure based on the normally distributed risk factors. We've already seen this in the form of the example of the stock portfolio. And in this case, we needed the value of the portfolio and the portfolio weights and the log returns as risk factors. And then what happens is we know that if we have normally distributed risk factors, a linearization such that the losses are also normally distributed, you can see that this follows a normal distribution with slightly adjusted mean vector and variance-covariance matrix. And then if you know that your portfolio returns are normally distributed, you can simply go back to, let me see, this formula here. You need mu, you need sigma, and a quantile that you can look up from the standard deviation from any table in a statistics textbook, and then you're done. So this is very simple. And because you're using, in the case of an option portfolio, you're actually using a delta approximation. This is called a delta normal approach. Delta normal or variance-covariance method. Also, why variance-covariance? Well, because it depends on the variance and covariances for the risk factors in the normal distribution. Very simple model. Assume normal distributions for all your risk factors, linearization of the risk mapping, and what you get then is a financial losses that are normally distributed, and then you can simply calculate the value of risk using mu plus sigma times a quantile. Very simple model. Okay, it's very simple. You can also use it in a conditional way if you use a time series model, but problem is obviously who tells you that risk factors are really normally distributed? So this assumption for a normal distribution is the main drawback of the variance-covariance method, and it's also naturally includes a linearization approximation, a linear approximation of your risk mapping. And in practice, you will never see risk factors that are purely linear related to each other and that are normally distributed. So that's a problem. So pro is, it's very simple. It enables us allows for an analytic determination of the var or is. Problem, linearization, normal distribution. But you can also extend it to other distribution families if it stays the same under a linear function. For example, a t-distribution, that could also work. Yeah? Second method is historical simulation. Also very simple. You simply take data, and instead of the normal distribution, you're using the empirical distribution function. So this is why it's called historical simulation. You're taking the empirical distribution functions. You begin with the construction of a data set of simulated historical losses. And the simulated losses, they are simulated because you're taking historical data on your risk factors, you're plugging it into your risk mapping in your loss operator, and because maybe you have only bought the portfolio later on and you haven't incurred these losses, they are called simulated historical losses because these are losses that you would have incurred if these were the historical values of your risk factors. So you have historical losses. What you do then is you take those simulated losses. They indicate what loss would occur if the changes in risk factors were to occur at the day S. And then assuming the stochastic process of risk factors changes is stationary, so you can't do this with a time series model, then you use the empirical distribution function of those simulated historical losses, take the quantile of that distribution, of that empirical distribution, and you're done. Very simple. It's also, in the discrete case, it's also simply using the histogram, your histogram of simulated losses. Very simple, very easy to implement. You can reduce the dimension by looking at the losses directly, but you need large data sets, you need historical data, and it's exclusively unconditional. You cannot use a time series model for this. Third model and third way of standard of calculating the valued risk is Monte Carlo simulation. It's simple, or it's very similar to historical simulation. The difference is that you now assume different distributions for those risk factors. They don't need to come from the from the same distributional family, but you can choose, for example, a normal distribution for x1, a t-distribution for x2, and so on. Then you simulate m independent observations from these models, from these assumed distributions. You plug it into your loss operator, then you again get simulated losses, and then you do the same as in historical simulation. You take the empirical distribution function. The nice feature and the difference between this approach and historical simulation is you're not using historical risk factor changes, but you are using assumed risk factor changes, assumed on the basis on assuming different distribution models for all those different risk factors. It might be that you want to assume a certain distribution, or that you know of some, and then it is easy to use these assumptions to simulate all those risk factor changes, plug it into the loss operator. You have simulated losses, and then do empirical calculate the empirical distribution function. The advantage is you can use any distribution model for those risk factors, and they don't have to be the same. You can go up with M up to say 100, 200,000 simulations, so it should stabilize around some value. Problem is you need a large computational effort, a high computational effort. You need large computers to do this. And since the portfolio loss must be determined for each simulation, this takes some time. Energy companies, even large banks, they usually have large grid computers for this, or computer grids for this, and they do this overnight because it takes up such an amount of computations. So that's Monte Carlo simulation. And these three methods are frequently used in practice. So it's Monte Carlo simulation, historical simulation, aka using the empirical distribution function, and variance covariance approach, aka normal distribution. So this is chapter 6 on risk measures and a little bit about backtesting, and we'll go deeper into risk forecasting and backtesting in section 7. But I would say we can stop now. A lot of information to digest for this lecture. Do you have any questions? Let me open the chat window. If you don't have any questions, then I would say we can stop here. If you have any questions, otherwise you can ask me via email. And then thank you for your attention, and have a nice week, and see you next Monday. Thank you. Bye-bye.